Welcome back, Grands, to the Club Mac Fiscal University. In the last chapter, Mark walked you through budgeting. Today, we are going to talk about one phase of budgeting, investments. Let's get started. Our goal in this chapter is to provide you with some strategies to start you on a lifetime of investing. To start us off, here's the sage of the Depression-era comedy. True in 1927 or will be in 2017. Will Rogers said, "Take all your savings and buy some good stock and hold it till it goes up. Then sell it. If it don't go up, don't buy it." First off, it's easier to save your money if you know what you're saving it for. Something called the future seems far away when there's a really great pair of Jimmy Choo shoes out there that you want to own. So, what are your investment goals? A new house, a new car, retirement, childhood education for your grandkids? Figure out what you want, then we'll get you started saving for it. And so we've devised the 3-bucket strategy. And as you see, leprechauns and pots of gold make very good visuals. We have a bucket for short-term needs, a bucket for intermediate needs, and a bucket for long-term needs. We're going to look at each one of these buckets and suggest investment strategies for them. First of these bucket strategies are the short-term needs. These are the day-to-day disasters that we don't anticipate but have to have cash for. This is our rainy day fund. Emergency repairs for your house or your car. Maybe a trip or a vacation. Or worst of all worst is if you would lose your job. The second bucket is the intermediate needs bucket. This strategy requires a 3 to 5 year time limit. We're looking at things like maybe a new house, a new car, possibly a new Club Mac member. The final bucket is your long-term bucket. This addresses long-range plans, has a longer event horizon, 20 to 30 years. This is your retirement. This is funds for your college education for your children. This needs some serious cash accumulation in this pot. Your short-term needs are your rainy day funds. Rule of thumb says you should have 3 to 6 months of expenses socked away somewhere. This is your first line of fiscal defense. Generally, you're not going to get very much return on it, but at least you've made a start. Liquidity is the key. You want to be able to get at this money when you need it. How to get started? Here's an easy way. Take that $5 latte you buy every day, put it in your special rainy day fund. At the end of the year, you will have $1,825. That's a pretty good start. What type of investments do you want to put your rainy day fund in? As I said, it needs to be liquid. It should be liquid, but it also should be separate. You don't want it to be in something that you can grab out for an easy purchase. An easy way to put it would be into a separate checking account, maybe a savings account, a money market fund. None of these you're going to get very much interest off of, but you will be able to access the cash when you need it. Certificates of deposit are another option. They have beginning maturity rates of every 3, 6, up to a year to 5 years, but those you are going to have your money locked up for a while. So the key is keep it liquid. Now that you've got your rainy day fund established, let's look at our second bucket. This bucket addresses the intermediate needs. This is serious cash for some serious purchases. This could be a new car, maybe it's your first house, or it could be a larger house. Maybe you've decided to add a child to the clan. These all have a little different criteria than you would have for your rainy day fund. You still want some liquidity, but you need to have a higher rate of return. You also want to have a little balance mixed in between stocks and mutual funds, and a little bit of risk is okay. One thing to look at for an intermediate investment would be a diversified allocation mutual fund. This is a mix between stocks and bonds. You can pick when you want this to mature. If you've got a target date that you need to buy a new house, that can be worked into that. It will also could have a risk of 60-40, that you have more in stocks than you have in bonds. It is pretty much up to you, and it allows you to tailor a fund to what you need. There are many companies that offer these: American Century, T. Rowe Price, Vanguard, well worth looking into. Another intermediate investment is an individual stock. What about stocks? Most people don't know how to buy stocks. We tend to buy high and sell low. If you're reading about a hot stock, chances are it's probably already reached its peak. Get advice, talk to a broker, find out what you can about the stock. Also invest in what you know. If you work for a company that has stock, buy some. You're investing in yourself. Other things to look at for intermediate investments would be a health savings account. Put money away to help pay for your medical bills that aren't covered by insurance. And a final thing is buy some disability insurance. Think of that Aflac duck. If you're not working, the duck will take care of you. Two final notes about stock, a little personal story. Years ago, newly married, had a car, needed new tires. Didn't have any cash, but I had Marion Lab stock, so I sold the stock to get my car fixed. Well, if I'd kept the stock and had money in a rainy day fund, I would have been able to buy 3 cars 10 years later. Final lesson in stock ownership is Crocs. We lived on an island. Everybody wore Crocs. Everybody loved Crocs. We bought Crocs. We bought Crocs at $10 a share. We watched Crocs go up to $60, $70 a share, and then we watched Crocs go back down to $10 a share. As Miss Ann has always said, there are 3 animals in the stock market: bears, bulls, and pigs. Don't be greedy. On to our final bucket, long-term needs. The good news, Americans are living longer. The bad news, most Americans aren't ready for it. The bad news for retirement is you're going to need 10 to 15 times your annual expenditures in order to live through your retirement years. And that's with inflation as an unknown. If you have kids you want to send to college, right now you've seen college tuitions, the sky's the limit. The good news about long-term investing is you have time on your side due to the miracle of compounding. If you invested $5,000 in a Roth IRA, for example, for the next 35 years, you would have a total investment of $175,000. If this was invested at 8%, you would have $900,000. If you wait 5 years, you would lose out on $300,000. So the time to start is now. As you think about your long-term needs, remember to be disciplined. Think too about Uncle Sam. Who knows where Social Security is going to be in 20 years from now. Also remember, by having 20 to 30 years to invest, you can be a little more aggressive now. You can get a little more conservative the closer you get to retirement. Switch maybe out of stocks, go into a little more bonds. That could make you very happy. Another thing I wanted to mention really quickly, you see a lot of them on TV nowadays, are annuities. There are some that are very good. Others that have hidden costs that will really eat into the money that you can possibly make on them. We would recommend strongly that you investigate before you invest. So let's look at the most common long-term investments. The first one is a traditional IRA. This you put pre-tax dollars in. It grows tax-free until you retire or start to take your withdrawal anytime after age 59 and a half. Then you pay tax on it. It's usually at a lower rate of tax than you're having to pay now. There are, however, significant penalties if you withdraw early, usually 10%. The cousin to the traditional IRA is the Roth IRA. These you put money in, they're after-tax dollars. You've already paid the tax on it. What goes into the Roth IRA continues to make money, and when you withdraw it again after age 59 and a half, you owe no taxes. It also has a max contribution of $5,500 a year. It also has a penalty for early withdrawal. With both Roth and a traditional IRA, there are certain circumstances you can withdraw the money. Most companies have abandoned traditional pension funds. Nowadays, they offer a 401k. This is a company-sponsored retirement program. It's great. You can decide what money to take out. The good news is it comes right out of your paycheck, so you don't see it. Most companies also will offer some sort of matching. Take advantage of a 401k. It's found money. When it comes to college plans, 529s are great. Almost every state offers them. It gives you a chance to put money into this 529 that will grow tax-free. They're usually invested in the money market funds that are targeted to when the little nipper is going to go off to college. You can make contributions every month, every week. They're a great investment. They give you a little bit of a tax break, and it gives you a nice pot of money to start the college fund. Investing can be complex. It doesn't hurt to ask for help. 2 recommendations. 1, look for a certified financial planner. These guys have taken lots of tests. They have a lot of information. Anybody can say they're a financial planner, but look for those 3 initials after your name and you will have a true certified financial planner. Secondly, have an independent source hold your stocks and your bonds, whether it's a Schwab or Fidelity that they will handle. You'll get an extra set of paperwork, which is always good. We all remember Bernie Madoff, who just sent out statements and he held everybody's paper. People thought they were making a fortune. They didn't have any money at all. Club Mac has been fortunate to have the advice of several financial gurus help us over the past several decades. We've been lucky to deal with Randy Hedlund and Tom Meyer, amongst others. They're great guys. They'll be more than happy to help any of the Club Mackers get started on their road to financial security. There are several websites out there that are also very helpful. Khan Academy is almost as good as Club Mac Financial University. Motley Fool has many tools to help individuals look at stocks, mutual funds, a lot of good background information on companies. Kiplinger and Forbes magazines have great magazines as well as online websites. Bankrate is another great resource. They have everything from CD rates to mortgage rates to great calculators to help you plan your future. There are also many insurance companies and mutual fund companies that have tools that will help you plan for your future. 20th Century, Northwestern Mutual, Vanguard. But remember, they all want to sell you their products. That's why an independent financial planner is good. Let him search out the products that are best for you and bring those to you for your final decision. When all else fails, go to the Dean of Club Mac University, Grandpa Jim. He's always happy to talk to one of you grands to answer any questions you might have. So that's it, guys. I hope this has been helpful. Just remember, saving is a lot like the Chinese proverb. The 1,000-mile journey begins with 1 step. And to finally close out in the word of our founder, let me know how it turns out.